You probably looked at your credit score and thought, I don't even know what half of this means. What do these scores really mean?
Maybe a lender told you that your score wasn't high enough, or you got turned down for an apartment in Arlington and no one explained why.
Hi, I'm Tom Cristiano, and this is Hugo Blankenship. We're credit attorneys here in Virginia, and we help people understand how this system actually works, so they're not caught off guard when a 3-digit number makes or breaks a major decision.
In this video, we're going to walk you through exactly what impacts your score, what shows up on your report, and how you can start improving things right now before it costs you a loan, a lease, or even a job.
Let's start with the heart of it. Why should you even care about your credit score? For folks living and working in Virginia, it's more than just a 3-digit number. It's the key to unlocking, or sometimes slamming shut, the doors to things you care about. Hugo, can you share an example from one of our clients?
Sure, Tom. We had a client from Arlington who had applied for a home improvement loan. She had been pre-approved at 6.5%, which was a pretty good rate. And right before she was about to close it, Verizon had reported a collection and charge-off on her account, on a disputed account. It was inaccurate, but when she tried to close the loan, they said, yeah, sorry, I can't get you at 6.5. Your new rate is 18%. So it shows you just how much one account can impact just any loan. But there are a bunch of different loans that are a problem, aren't there, Tom?
Right. Your credit score affects almost everything you do. When you go to the car dealership to get a car loan, it'll affect what tier of credit you can get and what down payment you may have to make. When you go to get a home mortgage loan, it might affect how much mortgage you qualify for, which would ultimately affect the type of house you can purchase or the neighborhood. So the credit score is really an important aspect of every part of every American's life, right, Hugo?
Yeah, and it even goes to your insurance rates. A lot of people don't know that, but insurance companies do look at your credit score, and they are going to rate you. If you have a lower credit score, you're going to be paying more for insurance. Also, you may have an inability to get an apartment because of your credit score. They're going to pull your credit score, and they're going to look at it. And there are also job issues, right, Tom?
Right. There are many job issues, especially in our area of Northern Virginia, where many people have a security clearance for a job. And we're here to help people. If you have a problem with your security clearance because of an inaccurate credit report, Hugo, why don't you tell them about one of the clients we had with that type problem?
Well, we've had quite a few that have had problems. And the first problem that they have is that they feel like they have to self-report. So when something like identity theft or an inaccurate account that's now gone to collection and charge-off appears on their credit report, they got to go into HR and they got to tell them, hey, I got this problem on my credit report. It's not only embarrassing, but it's also a problem. They could lose their security clearance. So it's a big factor and creates a lot of stress. So these credit reports and credit scores are very important.
Right.
So there's this company called FICO, right? And they have a scoring model that goes from 300 to 850. Tom, what are some of the factors that go into that FICO score? How do they make up that credit score?
Well, when you talk about credit scores, the very first thing you have to talk about is the person's payment history. This is the biggest chunk, and it's estimated at 35% of the score. So what do you need to do? You need to pay your bills on time, obviously.
Oh.
Even one 30-day late can kill your score. And I don't think you need a video to tell people to pay their bills on time, but it is critical. And what happens is if there's inaccurate credit reporting, and even if it's that one 30-day late that's inaccurate on your credit file, it can really be devastating to your score. Hugo, why don't you talk about mortgage payments and how they could affect your credit score?
Yeah, I've talked to mortgage lenders, and they've told me that if you have as much as one 30-day late on your credit report, you won't be able to get approved for a new mortgage or a refinance mortgage for 2 years. So whatever you do, don't let your mortgage go 30 days late. That could be a critical problem going forward.
No, we had a client she was based in Manassas, Virginia, and she actually had her last mortgage payment that got marked 30 days late because the bank made a mistake in taking the payment from her automatic account, and she couldn't get another mortgage to complete necessary repairs for her home. She was disabled. It was a real big problem. Do you remember that case, Hugo?
I do. That was a huge problem, and the bank should have cleared it up right away. She was trying to pay it, and it didn't go on to her auto payment, and then she was trying to write him a check, and it was a big mess. But the point is that because of that one 30-day late at the end of her mortgage, after 30 years of paying this thing off, she was not able to refinance and get another mortgage for another 1.5 years in that case, until we finally got it fixed for her. So that was a big problem.
Right. And the additional problem of having inaccurate late payments on your credit score is that those late payments can stay on your credit report for 7 years. The impact will decrease over time, but that doesn't mean you're not going to have a credit score problem right away. Hugo, the next item we need to talk about when it comes to credit scores is the balance on your available credit accounts. Now, this factor is estimated to be approximately 30% of a credit score. Why don't you tell the people about how this factors in?
Sure. This is the credit ratio. Okay. So this is the amount of available credit you have and how much of it you're actually using right now. All right. So if you add up all your credit cards and the limits on your credit cards, and then you add up the balances, and then you look at that ratio. Now, some people will tell you want to get it to 30% or less of your available credit. I think that you probably want to get even lower. If you can get it to 15% or less, that's a lot better. But one thing you don't want to do is you don't want to let any credit card you have be maxed out. So if your maximum balance is $2,000, you do not want that card at $2,000. Pay that one down. What about old accounts? What should people know about old accounts?
Well, generally, for old accounts, you want to keep older accounts open because the length of your credit history can affect your credit score. So what you don't want to do is have an old account that's been around and maybe even your oldest account on your credit file and close that out, because then that could shorten the duration of your credit score time period, which would ultimately lower your score, as affect also how many your credit utilization is as well, because that credit line would no longer be calculated as part of that utilization ratio. An extra $2,000 to $10,000 in available credit could be very helpful when they're making that calculation. And as I just said, you don't want to close the old account because it will affect your length of credit history, because that can be up to 15% of your credit score. So it's not just when you first had your credit, but how old your credit accounts are. Hugo, do you want to add anything to that?
Yeah, so that's a smaller portion of your credit score, how old your accounts are, but and that's referring to not when you first got credit. If you're 60 years old, maybe you've had credit for 40 years. It's how old the actual accounts you have on your credit report are. So those old ones that you have laying around that you haven't used in a long time, hang on to them. That could be very helpful in increasing your credit score. So the final category is new credit, or applications for new credit. What about those, Tom?
Well, new credit can be worth approximately 10% of the credit score. And the critical thing about new credit and credit inquiries, because you see many things online, people are upset or they don't want inquiries, or they talk about soft inquiries or no credit pull inquiries, whatever terminology people are using. This is because of the 10% factor of new credit. And what lenders really don't want to see, and what really affects the score, is a lot of new credit apps over different types of credit. So there's different types of credit, like car loans and mortgages and department store credit cards. So if you're out there running around trying to get credit from every different category of type of credit, that's really going to affect your new credit score more than, say, shopping for a car where the car dealer goes to 3 or 4 banks for that same car. Hugo, do you want to add on to that? Or?
Yeah, we get a lot of clients that call in and say that they're really upset that a car dealer might have shopped their credit around to 7 or 10 different lenders. Well, the credit scoring models are hip to that, and they know what's going on. So they know you're not looking to buy 7 to 10 different cars. So that is not going to have a serious negative impact on you just because they're trying to get multiple different ones. And the same thing is if you're applying for multiple home loan mortgages and you're trying to find the best rate around town, they're going to know that you're not trying to get multiple loans. Now, credit cards are a different story. If they see you applying for 5 or 6 different credit cards in the same 3-4 month period, that's going to be a problem. So don't do that one. All right. But as far as car loans and mortgages, that's fine. What's the final category?
The final category is the mix of your credit use, and that's worth approximately 10% of your credit score. You want to have a good credit history where it has a mortgage, car, credit cards, different types of credit that show that you're responsible and making your payments on time. Some will be installment loans like car loans, or revolving loans like credit cards with monthly payments based upon the balance. So basically, you want to create a good mix of good credit that you're paying on time.
But there's probably not much you can do about that one to try to improve your credit score. So it takes into consideration what kind of credit are you using? Are you balanced out, or are you just all credit cards? That's sort of what that one's all about. All right. So what kind of accounts are actually showing up on your credit report, Tom?
Well, obviously, like I just said, you're going to have your mortgage and your car loan and your credit cards that show up on your credit report. But what's not there are most of your major utilities like phone, gas, electric, and cable. These accounts are only reported typically when you go bad or you make late payments or it goes to collections. So you don't get the benefit of making the good payment typically, but you do get penalized if you pay late.
You do. And you got to be careful about those utilities, because one of the things they do is they go immediately to charge off. So if you've got a problem going out the door, like you've changed your cable company or your phone company and you went and hired somebody else, make sure you get everything paid off and get that in writing, because any problem with them can be a very serious problem going forward. Also, rental properties. Most of the people who are renting and they're paying their rent every month on time, unfortunately, that's not going to impact your credit score. So that's a problem too. What about bankruptcy?
Well, obviously, if you have a bankruptcy, it's going to significantly affect your credit, but it shouldn't affect your credit forever. The bankruptcy reporting itself, the Chapter 7 will stay on your credit report for 10 years, and Chapter 13 will stay on for 7 years. But as we covered in another video, the key to bankruptcy is, are they reporting information accurately after your bankruptcy is filed? Because what you'll see is the wrong chapter of bankruptcy is on a credit file after you file, or they put a balance on there that was included in the bankruptcy. So bankruptcy does and should impact your credit, but it shouldn't be forever. And what you should do is 6-7 months after your bankruptcy is discharged, get a copy of your credit file from annualcreditreport.com and go ahead and see and make sure the bankruptcy is reporting accurately.
All right, so let's talk about some practical tips that you can do to try to improve your credit score. So the first one I would say is make sure that you pay all of your accounts on time. And even if you go late, let's say you're 10, 15 days late, you're having a problem making a card, don't let it go 30 days late. That's where the problems are, okay? So even if you're getting a late fee, that's not going to show up on a credit report. But as soon as it goes up to 30 or more days, that's when they start reporting it. And you got to make sure that that doesn't happen. Now, what can people do to try to look and see what's on their credit report, Tom?
Well, the best thing you can do if you want to see what's on your credit report is go to annualcreditreport.com and pull your credit reports from there. That's annualcreditreport.com. You want to look for negative accounts and anything that's wrong or inaccurate. And if you see an inaccuracy, you need to write a good credit dispute letter and mail it to the credit reporting agencies. If you have a maxed out card, pay it down. That's another thing you could do. Any other tips, Hugo?
Yeah, I mean, you want to try, as we talked about earlier, you want to try to make sure that your total debt to credit ratio is below 20% if you can. So pay all those credits down. You can ask credit cards to increase your credit limit. That will increase your available credit. And you want to make sure, as we discussed earlier, keep old accounts open. Don't start closing those things down, because those also increase your available credit. What about credit repair companies, Tom?
No, we typically caution people not to engage in credit repair. Credit repair companies try to game the system to do multiple disputes to trick the credit reporting agencies into taking legitimately bad debt off of a credit report. So they'll get you into a monthly program and they'll make false claims about what the CRAs have to do and what they can do to fix your credit report. They'll claim that real accounts were opened by identity theft. And there's a lot of different ways that credit repair companies operate. And the reason why you don't want to engage with a credit repair company is because ultimately it will make you look bad down the line when you have a legitimate item that's inaccurate on your credit report. Hugo, how do the credit reporting agencies figure that out?
Yeah, we've deposed a lot of people from the credit reporting agencies, and they are very hip and very concerned about these credit repair companies. They have a list of fraudulent police departments that people send in, and they claim that they filed a police report with them when they haven't. And they're hip to exactly what it looks like when a credit repair clinic sends in disputes. They usually come in large batches with hundreds at a time. They're never signed by the consumer because they don't let you see it. Postmarks are all the same, coming from the same place. And as soon as they see that, what do they do with your credit report when they see that?
Well, we'll see instances in the internal files where they'll mark you as a credit repair clinic person. So it's like getting the scarlet letter on your credit file, where they know that you may have a history of filing inaccurate disputes, and that makes it less likely for them to want to believe you when you have an actual problem with your credit file.
Well, you're like the boy that cried wolf, and the credit reporting agencies mark that on your file. And as soon as they do that, the chances that you're going to get something that's really inaccurate off are a whole lot less. So stay away from those things. It's just a waste of money, and it also can make things a lot worse for you and make it a lot harder if you have a real credit problem and you can't get it fixed. What else can they do?
Well, they can make sure their credit score keeps working for them, obviously by keeping an eye on their credit. And if they're going to apply for a home loan or auto loan, start early in the process, so they can see what's actually reporting on the credit file and promptly dispute any erroneous claims.
Yeah, that's one of the things that's a pretty good piece of advice, Tom, is if you know that you're about to apply for a home mortgage, then pull your credit report and take a look at it. If there's something that's wrong on your credit report, you want to get that fixed before you do that application, because increasing your score can seriously decrease your rate, and you can save a whole lot of money by making sure that you have the best credit score and the best credit report that you can. Another thing that mortgage lenders are going to tell you is try to pay off all those debts that you have. All right, pay everything down as much as you can. And if you have charged off old debts, what should they do with those things?
Well, they should probably make payment arrangements and get them paid off, so they report as a zero balance on the credit file. And one of the things you can do if you're having a hard time, it's actually better to not let the account get charged off. So if you're in the point where you're talking to a lender or your bank, and they say, we need you to pay some money so the account doesn't get charged off, you probably want to take them up on that so the account doesn't get charged off. Once the status becomes charged off, you're past 30, 60, 90 days past due, and you can never get it back to like almost current. So what I always tell people to do is don't let it charge off. So if you come back in time and try to rehabilitate the account, it's better to do that from a 60, 90-day late standpoint than it is from a charge off, because the credit reporting number is a 9. So if it's a revolving credit card, it will report as R9 on your credit file, and that 9 will never go away. Whereas if it's 60 or 90 days late, you'll have it R5s and such. So if you can get the 5 back up to a R1, so that'll look better on your credit file.
Here's another tip. When you have these old charged off debts, okay, and you call up the debt collector, and the debt collector says, hey, if you pay me 50 cents on the dollar, I'll go ahead and mark it as paid. Unless it's a big debt like $5,000 or $10,000, don't accept that. And I'll tell you why. Okay. What they're going to do is they're going to say, yeah, you've paid it off, but they're also going to mark it as paid less than full balance due, which means that you never really fully paid the debt. And creditors look at that and they go, man, you're not really a good credit risk, because I lent you $3,000 and you only paid a portion of it back. So if you can, pay them off in full. It will seriously help your credit score.
Good advice, Hugo. Now, we've covered a lot about how to get a better understanding of your credit score here in Virginia, why it matters, what goes into it, what's reported, your rights, and steps to take right now.
If you want to go even deeper, you need to catch our next video, Non-Traditional Credit Reports, What You Need to Know.
This one's crucial if you pay rent or utilities, or if you've been turned down for credit and don't know why. Don't risk another surprise. Your financial future could depend on it.
And we'll see you next time. Thanks for listening.